Hi, Gaby. Welcome to the Buy, Grow, Sell podcast.
Hi, Simon. Thank you for having me. Appreciate it.
Well, my pleasure. My pleasure. I'm very much looking forward to unpacking your story. Gaby, I've had the benefit of maybe having a little look over your profile leading into this, but just for our audience, maybe you could just give them a little bit of a background and sort of where you came from and all that sort of stuff, and then we'll get into the businessy stuff in a minute.
Yes, absolutely. A little bit of my background. I'm originally from Caracas, Venezuela, and I like to say that I went to the United States for 2 years, 26 years ago. So I never head back. But my background, I'm a software engineer, and I did my master's degree in information science, and I went to work for law firms, and that's where I started my, let's say, my career as an entrepreneur. I built two high growth SaaS legal tech companies, and that with two successful exits to Fortune 500. My first company, Billing Hub, it was acquired by Thomson Reuters, and that company was bootstrapped. And we grew that company very large. It was acquired, and then we stayed in legal tech, and we started Bellefield with, we grew that company in about 7 years. We got acquired by Roper Tech, that has one legal vertical within that. And that was in 2019, right before COVID. And fast forward, I had the opportunity to start a VC fund, small fund, focused on investing in female-led startups. And that's my passion right now. That's what I'm doing. And that's a little bit of myself.
I I love it. I love it. You've made it. Obviously, been very successful, and you're paying it forward and helping other people on their journey. Which, hey, that's what this podcast is about, right? Is sharing stories like yours so other people can hopefully
Yeah.
learn from them and shortcut their success. But I do love, Gaby. I've got to say, most people would love to build one company and make it successful and sell it to a Fortune 500 company. I've even had people on my show sometimes who say, I was pretty lucky. But I think if you've done it twice, that whole idea of luck kind of goes out the window. I'm starting to think this is very much a skill and smarts kind of thing.
Maybe, right? I mean, maybe I was like twice, right? That's fun. Yeah. But I would
Yeah.
say, Simon, that it's always a lucky factor, right? Just, the ability that I was able to leave Venezuela before the crisis started, that was a matter of luck, right? And
Yeah. Yeah.
but again, I mean, I like to say that the harder you work, the luckier you get, right?
Yeah. Indeed. Indeed. Yeah. You make your own luck. I totally agree with that. Um, so talk me through. I'd like, I guess every good story has a beginning, middle, and end. So maybe talk to me a little bit about what's it like to start a SaaS company. Did you have partners? Did you have an exit plan in mind? How long? What did you think the journey would look like when you were starting these businesses?
Yeah. So starting out, we knew that we wanted to build amazing software and solve problems. And through the journey, we learned that if we build amazing solutions that really help people and we add value, we're going to get revenue in return. So we didn't start out like, okay, we're going to sell this for 1 billion, 2 billion, right? It was more like it's hard to think that you're going to be passionate about legal tech, right? And working, right? Kind of like it's hard to fathom, right? But I think I was more passionate about solving problems, right? Creating very innovative technology, and in doing that really well, Simon, success will follow you.
Yes. Yeah. I love that. I think it's people can be too focused on the success and you end up chasing your tail. It's in the end it's all about people and real world problems. I think is seems to be a common thread with most of the people I've spoken to. And did you said we a few times, so did you have business partners when you started off?
Yes, yes, of course. I had in my two companies, I had my co-founder and CTO, which happens to be my husband.
Cool.
So yes, two companies, two boys, two kids, and many years of marriage. So yes, so it is not very usual, right, to have this journey with your, spouse.
Yeah, I totally agree. My wife is the co-founder of our business, and in fact, every business we've done together. It's funny. Friends of mine, we were having a few drinks on a Friday, and a couple of mates were saying to me, "So you work together, you live together. We saw you out exercising together the other day. Like, this is weird. You guys are weird." And I had to try to explain to them that it's this weird, odd sensation or odd scenario that I actually really like my wife. It's, maybe a bit strange, but we
Yeah, I do.
so have, have you found that working together has any specific or distinct advantages or disadvantages compared to other business relationships?
I think it's I mean, it could be, at least in our case, it was a tremendous advantage. And the reason why it was a tremendous advantage, we were 24/7 thinking how we were going to solve the problems, how we were going to innovate, right? And kind of like this interaction of thinking, solving problems, I think it gave us a competitive advantage. Of course,
Yeah,
I think part of the key on that, Simon, it's three things. We knew our roles. I was CEO, he was CTO. We have clarity, that I was running the direction of the company. We were working on the vision. And so we didn't step on each other's toes for the most part. And we
yep,
developed protocol for conflict resolution. So
yeah,
when
cool.
we couldn't agree, right, or there was too much of we were not aligned. So we had a protocol on how we were going to resolve it. That's for another podcast.
Yeah, that. Yes, indeed, indeed. Um, I ask a question here, I guess from my own experience, but it's um, I certainly, well, maybe it's more of a statement. I certainly know with my wife, there are times when, sometimes you can't, you've got so much going on in your business that, you're wanting to voice it, but the other person is at that point where they don't want to talk business anymore. And yeah, please.
Yeah, yeah. So we kind of like agree, right, that if we could not have I'm Latin, right? My husband is from Spain, also very Latin. So we will get in very passionate discussions about technology, direction, vision. And part of this protocol, it was if we cannot have a dialogue in how we're going to solve this problem. We're going to put it away, right? And we continue the next day and we don't talk about this issue anymore, right? So kind of like a
Yeah,
settle, right? And we come back and revisit, right? And then, and there were
yeah,
some norms of conduct, right? And that I mean, we couldn't get too passionate about it, right? So yeah, interesting. But I mean,
yeah,
we kind of like developed that over time, Simon.
yeah,
It was very passionate. And even for our employees, it was hard for them to really understand. I mean, we're very, very Latin, right? That, we're having these very passionate discussions, right? And then we walk out and we're incredibly happy and laughing and all that, right? So,
yeah. Well, and I think you've got to be passionate about things too, but I can appreciate that. It's, yeah, no, it's cool. There's always an interesting dynamic with merging personal and business life. Um, one of the things I've always found as a benefit too is that, like, when you're trying to take on the whole world out there and do great things and manage all the challenges, it's good to know that somebody's got your back, right? Somebody that you can just trust. You don't have to fight a war on two fronts. It's sort of, well, hopefully doing business is not like doing a war, but you're out there, right? You're putting yourself out there, you're taking risks, you're doing all that stuff. And I think as soon as you split and you're divided on two fronts, it's very, very hard to achieve anything.
Yes, I agree.
So, Gabby, talk to me a little bit about startups for SaaS companies. I mean, I seem to talk to a lot of SaaS entrepreneurs these days, and I guess there's a lot of decision points here of, do we try to bootstrap? Do we seek funding? Do we, there seems to be lots of different routes. When do we expect to make money? All this sort of stuff. Like, if somebody's sitting here looking at the beginning of starting a new SaaS business, I mean, what are some of the things you would suggest they need to be aware of?
I mean, that's a complex question, because it depends on the vertical, right? The experience of the founders. But in our own experience, the first company, we bootstrapped that company. The main reason that we bootstrapped that company, it's because we were foreigners. We didn't have access to the VC network, right? And we knew that we were able to build, this technology ourselves. So it took us a lot longer. At most, we would have raised capital. So the second time around, we had a successful exit. The second time, we didn't raise money, and so we put our own capital on the second company. But in Simon, I think this kind of like tied into kind of like at the core of the podcast. Towards the the end, I think 6 years into the business, we were growing very rapidly, 150% year over year. And, kind of like the successes that bring you, to, the first couple of $1 million, right? And you continue to grow, the skills change, right? So whatever your success at the beginning is not what is going to take you there, right? So, we understood that in order, to become, a large company, we needed different levels of skill. So what we thought, we were already, the established solution in the market. We had the largest law firms in the world using our solutions, large accounting firms. And so we decided, how do we take the company to the next level? And we started doing an equity raise, equity growth raise. So a year before we sold the company, we were approached by a number of private equities. A little bit of that, it's at some point we were growing, very rapidly, and we became an acquisition target. So once you become this acquisition target, you start getting inbound calls from VCs, private equities, investment bankers, right? And so, Simon, I think we would have probably like 5 calls a week, inbound.
Yeah.
It was very active, and we will entertain. And through that, it was a great exercise, Simon, because you start learning and understanding who you want to partner with, either for acquisition, growth, equity, and those type of things. And you also start building relationships with these, investment bankers, private equities, VCs. And that went really well. So the year before we sold, Simon, we got 3 unsolicited offers. And, we weren't surprised, because, you already are engaging into these conversations. And probably for your listeners, something that we knew the industry really well. We knew what the range of the valuations of well-run companies, right? So it didn't come as a surprise. So we were kind of, so you need to know what is going to be your range. And I'm talking from the software SaaS, type of businesses. So we did get these offers, and we say, okay, let's entertain these offers, and we can do it ourselves. So we have great lawyers, of course. We know many, many lawyers. We have great accountants. We know many accountants, so we can entertain this process. So when we started kind of like understanding what is in these LOIs, right? What is in these term sheets, right? So that the complexity, right, in the things that got a little bit tricky. It's when we started seeing earnouts in these LOIs, right? So we had a team of lawyers, right? And we decided to park the process. So we decided we are not going to go forward. So, I mean, we don't have to do it right now. And probably in a year, we will revisit and we will work with an investment banker. And that's what we did.
That's really fascinating. You're getting 5 calls a week. I mean, how much of a distraction can this be from your everyday core business?
I mean, Simon, that was my job, right? So I like to say that as the CEO, you are kind of like at the first line, right? And it was a distraction, but what I will say, it's the more you do it, the better you get, right? And the more you prepare to that. So yeah, it could have been, but I think it was very beneficial for the outcomes that we were able to achieve in how we run the business that I would love to tell you about.
Yeah, for sure. Well, let me take it back a step a bit. Why don't you tell us a little bit more about those businesses, and if you can give us some context around size and things like that. Just I mean, whatever you can share. I obviously appreciate confidentiality, but yeah, take us through them.
Yeah. So again, I mean, we were a player in legal tech. So in terms of sizes and transaction, still that's something that we cannot disclose much, right?
Sure.
But I mean, we were growing 150% year over year. So that gives you a little bit of the track record, what it will be, 7 years after, right?
Yep.
And mhm.
Yeah, sorry to cut across you. And obviously it's a SaaS model, it's recurring revenues. What can you tell me because we talk about valuation and there are lots of different methodologies for valuation. So I guess without revealing your numbers, was there a particular methodology typically that was used in your instance? Like how did they come up with a number?
Yes. And so for this vertical that we were, right, which is legal tech and, accounting tech, we knew that, well-run companies, and I will define right after what is a well-run company, great valuations were between 5.5, 6x, and 10, which is where you want it to be. ARR.
So annual recurring revenue?
Annual recurring revenue, right? So,
yeah, cool.
In something that the second time around, we did really well. It's from the beginning, Simon, we decided to engineer the company that we wanted to grow and be very successful. So that's why when I said a well-run company, in SaaS, there's something that, is called the rule of 40. The rule of 40, it's if you add up growth and earnings, EBITDA, it should be at least 40%, right? So either, you have 40% growth and 0 EBITDA, right? And still, in our case, right, 40% was kind of like a deferred minimum, right? So they're looking for like a 80%. So, we understood the industry the multiples, right? What was, building a successful company. So when we sold, we were 99% recurrent revenue. And I would like to double click on that a little bit later. Why it is so important? Really focus on recurrent revenue because that's what you get value on. So, we had a 93% gross profit margins, which is what you really want when you're, running a SaaS company. And we were, I'm going to say very lucky, but we were not. And we had about 28% EBITDA. So,
very good.
so when you combine the growth, right, with the EBITDA, with the profit margins and the retention, and we had about 102% retention. So all these factors, right, were instrumental for us to get the highest valuation. And so, Simon, when I say engineering a company to success, it's that you gotta keep this in mind from the very beginning, because not every revenue is a good revenue. In our space, because we were selling to large organizations, we will fit more into the SaaS enterprise. We were very deliberate in the staying away from consulting revenue, staying away from non-recurrent revenue, because we were not going to get credit for that. And a funny story. It's our CTO. He was known for being Mr. No. So part of as the chief technology officer was saying no, right? And I think something for us entrepreneurs to learn. It is okay to say no, because that can really work against your company in the long term.
Yeah, that's some fantastic advice there. I think it's this concept of constantly chasing shiny things, I think, is a very common analogy for a lot of business owners. So that doubling down and focusing is really interesting. I read somewhere about even one of your solutions, and I think this was with Bellefield, about even doubling down on your niche within the legal space. Is that right? Have I got that right?
Yes. So exactly what do you mean doubling down in the legal space?
Well, I was reading about, instead of just targeting broadly the legal kind of industry, that you started to even niche down within the legal industry on certain areas. Have I got that right?
Yeah, no. That's our market, and I think like other verticals, they're segmented. In this industry, you have the SMB, right? Small and medium. You have the large, and you have the mega clients. So we started out, with the small and medium clients, and the reason it's because their demands are a lot less if you are working, with a law firm or an accounting firm of 10,000 people, right? That worked for us really well. So we really kind of like made a name for ourselves in that. And then we continue to build more enterprise features to serve a more demanding audience. And more demand from security audits, right? ISO certifications, SOC 2 certifications, and those type of things that this type of client demands. So we proved the solution. We really solved problems. We got our clients to really love, the application, and then we went up market.
Yeah. No, that's interesting. Talk to me about product and this, I guess, the product and service that you offered for a bit. I find a lot of entrepreneurs come to some point, some crossroad in their journey, where they're looking for more growth, and they have this option through their mind of, do we diversify and start to offer new products or services to our existing customers? Hey, we've got legal tech, we do timekeeping, now we want to offer billing. I'm just picking stuff here, but this whole idea of building additional stuff so you can cross-sell to those existing relationships, clearly a much easier sell because they know you, or really kind of doubling down on your specific piece of tech or your specific product set. Did you find that did that decision or those thoughts come to you guys as a business at some point?
Yeah, Simon, I love that question. I love it. So we had a vision, and you don't realize that vision on day one. So our vision was we wanted to own the lawyer's desktop. So we want to be in the few things that they touch, because they don't touch excessive technology. They do a finite number of functions. We want to be there. So what we did is we kind of like did the time tracking and the timekeeping really, really well. In that end, we started adding products to augment the value of that function. So we added compliance. Imagine that you're serving a client, you are tracking your time, and you will know immediately whether you are going to get paid by your client or no. So we did do that. It was we added another product to help them to meet the firm's policy. Like, you need to have this many hours, right? You need to enter your time, within so many days. And so we built about 3 other products, but they were complementary to really realize the vision. So it wasn't kind of like darts, throwing dart, right? It was why I go back the importance of realizing your vision, right? In having at least to have some clarity on that early on, and then you realize how you want to execute it. You learn from that, and of course, once you have your client base, upselling it's a lot quicker because the trust already established, than acquiring new customers. And for customer acquisition, you have kind of like other solutions to sell. And because if they were using let's say a competitor product, they could still use the other solutions and still get value. Make sense?
Yeah, absolutely. No, that's really interesting. I guess it sounds like the things you introduced were highly leveraged into your existing product sets to help, well, I guess make customers a lot more sticky as well as a lot more valuable.
And that's key, because we became so sticky. That's why retention was incredible, which it goes back to engineering a company for success, right? Retention as well.
I'd like to touch on this topic a little bit more. I think you mentioned double clicking it before, which I kind of like that. We do a lot of valuations. We've done a lot of transactions. We're doing many of them now, and it's often as a part of my job is explaining to business owners why, in some cases, our valuation expectations is perhaps sometimes lower than theirs. And I'm often explaining this idea that, look, your past is lovely and it's part of your story, but a buyer is buying your future. Right? They're buying your future stream of revenue and profitability and all, and what the future opportunity is. And I add to that I've never met a buyer yet who wants to buy a business and just keep doing what the previous owner did, right? Like, they want to grow it, they want to scale it, they want to do all these sort of other cool things. But explaining to people that when a buyer looks at your business, they're really looking at that future stream of profit and how reliable it is, and what sort of risks sit around that not only that profit eventuating, but what are the risks that they will or won't be able to scale it as well. And I think this is where this whole recurring revenue sort of part comes into play, right?
Yes.
Have you got any views around, I mean, for I don't know, maybe you can talk through your experience a little bit here. You've talked about retention rates and stuff like that, but how important is this in the discussions with buyers around valuation and getting a deal done?
Um, it is extremely important because, like you said, it comes down to the future, right? I mean, they are paying 6, 7, 10 times, right? The value of your recurrent revenue, right? Because of, for the future to really get 20x out of that investment.
Yeah.
So, what are the key pillars of that? There's a good green space, and there is a very and also white space. Okay, so to continue upselling, products to this customer base, right? And there is a green space within that vertical and other verticals. In our case, we were the leading in account in legal because that was the vertical that we knew. We were very comfortable. But the other verticals were accounting because they also do tracking and pretty much any professional services because they all have to keep track of their time. So the opportunities were many within this and many other. That's a key factor for the acquirer, right? The other is what is the state of the technology. They don't want to buy or pay for technical debt. I don't know if you're familiar with the term, right? They don't want to pay for that.
So please explain that to us for anybody who doesn't understand the term.
Yes. So basically, they want to make sure that the technology that it's built is not aching, right? It's solid. It's built to continue to grow, and typically the acquirer they have either a thesis or they have a very strong vision. So having technical depth, so you may have great customers, right? You can be a name on the market and have a technical depth that is gonna discount your multiples. So you're gonna pay for that. So that's why especially for technology companies, have a very solid team, of course, right? But also keep that in mind that, you cannot be patching, right? And having kind of like a Frankenstein type of architectures, right? Because at some point, you're going to get discounted for that.
Yeah.
And then,
that makes a lot of sense.
and I think the last pillar, Simon, is a reputation, right? So, you are buying, you're paying a lot of money, right, for a company. So you want to make sure that there is some brand, that it's in good standing so they can elevate that and incorporate it within their brand. So I think it's, the reputation, of course, the metrics and the KPIs and all that, in the technical, at least for tech companies.
Yeah. That's fantastic, Gaby. Thanks for that. I mean, I'm imagining almost a vehicle in mind, like they're buying a vehicle to get them from point A to point B, and they're looking at all these parts and saying, well, how well is this thing constructed? Can we trust the manufacturer, the brand, all this sort of stuff? It's, ultimately you're selling them a solution ultimately for where they want to go, right? And they're looking to see if it's fit for purpose.
Exactly. And if it's in good standing, right?
Yeah, for sure. Talk to me a little bit about when you finally did sell Bellefield. I understand you were getting all these offers. That's got to be quite complimentary getting that many offers and calls as well. So, and clearly it's important to creating competitive tension, no doubt giving you confidence. You said that you stopped though, and then you kind of paused things for a little while. And then at some point, obviously, you got some investment bankers involved. What did the process look like once you decided to kind of really do it thoroughly? Like, how long did it take? What did that all look like?
Yes, awesome. We paused for about a year, and we're growing, right? And we really needed to focus on the growth, and we did that. So at some point, we realized, okay, we I knew what was the number to give us the multiple that we wanted. So
Yep.
we hit that milestone, and I said, okay, we can start the process right now. So pretty much we were ready to embark this journey. In a little bit of what I said before, we were already working on relationships with investment bankers, private equity. So when it came to decision time, I already had three amazing investment bankers that I wanted to do business with. So we went through the RFP process, right? And we selected the best fit for us.
Yep.
Through that, and we really developed a great relationship with the investment banker. In something that we did quality of earnings analysis before getting into all the details. And the entire process took about 4 months.
Okay. Okay.
So, which is relatively quickly, for the
Yep.
size of the transaction. It took about like a 2 month to go through the book, um, in the pitch book, getting all the metrics together. Uh, and after that, so we went to market, and we got solicitation for 100 NDAs to look at
Wow.
the
Yep.
deal.
Yep.
And so after that, we got about 40 inbounds that they wanted to move forward, which 40%, it wasn't a bad rate.
That's a good strike rate.
And from then we got 12 LOIs, letter of
Wow.
intent, right from there.
Congratulations. I mean, that in itself is I think, testament to how good your business was.
And incredibly humble, throughout the process. But something that we did really, really well, Simon, it's we had all the organization, we work with investment banker, they will double check every number. So when it will come to diligence time, there were no discounts. Okay.
Yeah. No surprises, right? No surprises.
Also, so
Yeah.
and a little bit after that, and talking about the process. So we narrowed that down to four, and out of those 12, in the old days before COVID, you will have the investors to come in. You take them to dinner, right? You have a full day presentation, right? So we did that for 10 of them, and which is a very intense process, and you're trying to keep some confidentiality with the employees,
Yeah.
right? So sometimes we will go to them because we didn't want to kind of like if the transaction wouldn't go, we didn't want to cause alarm or chaos within the organization. So we narrowed it down to four, then to three. But having four people interested, Simon, which is what I believe that we could have not done this without the investment bankers and the professional. It created kind of like a bidding situation. So, which is, ideally what you wanted. And,
Yeah.
and at the end, Simon, we chose the partner that we wanted to. All of them were amazing, and probably gonna hear the podcast. But we believe that Robert, was the we had the best alignment in terms of industry, the best alignment in terms of employees, and we closed the transaction in 45 days with Thanksgiving included.
Yeah.
So mean, it went as planned. So
That's fantastic. Yeah.
planning helps.
It does indeed. It does indeed. Um, and that is a very quick time. Did you? I find all transactions tend to have either one or more component to them. You know, there's maybe cash up front, there's maybe a deferred, and maybe earnouts and stuff like that. Can you share any kind of sort of? Did you have earnouts? Did you have any of that sort of stuff? How long did you have to hang around?
Yes, that was part of the early conversations. We had two type of buyers. We had financial buyers where they were the private equities. Typically, they will buy, let's say, 80% of the assets, and you will continue to stay in the company, running the business and taking it to the next level. And for
Yeah.
founders, it's called, taking the second bite of the apple, right? And, that was incredible because, I mean, the private equities that we were working with, it was tier one, amazing. And but the strategic buyer, it was 100% sell, cash sell.
Okay.
So pros and cons. Um, but um, but I think so. We went with a strategic buyer, 100%, and we knew that they had their organization. Kind of like to repeat what you said, they had their own vision, they had their own plans. So what we agree that we will better serve the organization just doing a transition, and they kind of like taking it to the next level that their vision, was going to take it. So
Yeah.
we stayed 3 months for the transition.
Yep.
It went great. We did it on time, and then I was without a job.
Which I suspect is a bit of a rare situation for you. That's cool. I like that. Did you feel any kind of a little emotional stuff at the end, like, oh my goodness, I'm giving up my baby or anything like that?
Yeah, it was. I don't think you have to live through that. I don't think anything can prepare you for that. I thought that I was prepared. I thought that we made a very rational decision, but when the moment comes, it's a sense of emptiness. And
Yeah.
I talked about that after we did the transition and we sold. My identity went with that as well. So
Yeah.
I had a name in the vertical, right? I love what I was doing, and and all of a sudden I have to kind of like wonder, who am I, right? I'm not the Bellefield CEO anymore. Uh, in in kind of like a learn that my identity was not 100% tied to that. And I went through kind of like a trying to reinvent myself
Yeah.
through that. And I think, this next phase, Simon, is the best thing, that I could have ever wished, which is investing in the next generation of female founders.
That's
So
fantastic. That's fantastic. Talk to me a little bit about the fund if you can. I'm cognizant of your time here, but can you tell us a little bit about the fund? What sort of business do you look for? What's an ideal kind of, I don't want to say target. I mean, what's the ideal kind of people that you invest in, other than
yeah,
being obviously female?
so we're in a small fund, and we invest in early stage startups where the CEO it's a woman, and we decided to draw a hard line on that. So we participated in rounds that are like 500,000 to 1.5 million, with some valuations kind of like around less than 10 million. So that's our sweet spot, early
Yep.
stage And we believe that's when the capital is needed the most for, let's say minority founders. In terms of, we're vertical agnostic. So we invest in companies that are technology companies or tech-enabled companies. And yeah, anybody that is listening to the podcast, right now this fund invests only in U.S. companies. But so probably the next fund will be international. But yeah, so anybody that is listening to podcasts that have an early stage startup with founded by women, we would love to hear. And our fund is part of a global fund, and we have a fund in Australia. So
yeah, cool. So you're saying you've got a fund in Australia. So, but at the moment it's US companies. Hopefully down the track it'll be international. I certainly know a number of female entrepreneurs here who are also looking for investment and things like that. So if nothing else, I will point them in your direction so that they can at least understand who you guys are. Because I think if you're all pulling in the same direction, that's a good thing, right? It's about helping good people with good ideas. So congratulations.
Yes, in seven, the numbers are not in our favor. In 2021, 2% of the VC deployed dollars in the US went to women, only 2%. Yep. So, there's some good work to be done there.
There's a lot of work to be done there. So, but I suspect that with people like you on the mission, Gaby, I think we'll start to see some change. So, absolutely. Gaby, thank you so much for coming on the show. I mean, I've really enjoyed listening to your story. I could probably talk to you all day about other stuff, and I've got a million other questions, but I do appreciate you coming on and sharing. I think there's some really great insights. I was, tapping away and writing a few notes as we were going, because I just think there's some really brilliant insights to share. So, you've been really generous. Thank you. Thank you for coming on.
Thank you for having me. Appreciate it. Thank you, Simon.
Awesome. For anyone listening, if you would like to reach out, we will put some links in the show notes so that you can get in touch with Gaby, certainly so you can check out the fund, her LinkedIn site. If you do reach out somewhere, maybe just let Gaby and her team know that you heard her on the Buy, Grow, Sell podcast so they have a little bit of context. But other than that, I hope you enjoyed the episode as much as I did.